Hey everyone, and welcome. Today, we're going to talk about something called corporate actions. Now, I know that sounds a little, well, corporate, right? But stick with me because these are the secret messages companies send to you, their investors. And understanding them is absolutely key if you've got any money in the market. So let's jump right in.
So imagine this. You log into your brokerage account one morning, take a sip of coffee, and wait a minute, you suddenly have double the number of shares you had yesterday. But when you look at the total value of your investment, it's exactly the same. What in the world just happened? You're probably thinking, is my account broken? Don't worry, it's not a glitch. You just experienced a corporate action firsthand.
So, what are these things, really? Well, a corporate action is any big decision a company's management makes that isn't just part of their normal, everyday business. It's a strategic move, and it directly impacts shareholders. That's you. Think of it like a major update from the company's headquarters, telling you about its health, its strategy, and what it's planning for the future. Okay, let's start with the best part, when companies decide to share the wealth. This is when they open up their wallets and give some of the profits back to the people who own the company. And how they do this tells you a whole lot about what management is thinking.
First up, and probably the one you've heard of most, is the dividend. It's actually a beautifully simple idea. The company made a profit, and since you're a part owner, they're giving you your piece of the pie. It's a direct cash payment that lands right in your account. It's a real, tangible reward for being an investor, and it's a great sign that a business is healthy.
But getting that cash isn't quite instant. There's a process. First, on the declaration date, the company makes the official announcement. Then there's the record date. You have to be on the company's official list of shareholders by this day. Now listen up, because the most important date for you is the ex-dividend date. To get that dividend, you have to own the stock before this day. If you buy it on the ex-dividend date or after, the person who sold it to you gets the cash. Finally, there's the payment date. That's the day the money actually shows up.
And clarity is everything here. In the past, companies would announce dividends as a percentage of face value, which was, well, honestly, was pretty confusing. Look at this. Company A and Company B both announce a 50% dividend. Sounds the same, right? Wrong. Because their face values are different, Company B is actually paying out 5 times more cash per share. That's why SEBI mandated that companies declare dividends on a per-share basis. It makes it so much clearer what you're actually getting. All right, another way a company can return value is with a share buyback. This is when the company takes its own cash and goes into the open market to buy its own stock. This reduces the total number of shares out there, which means your remaining shares now represent a slightly bigger piece of the company. It's a huge vote of confidence. Management is basically telling the world, hey, we think the best investment we can make with our money right now is us. Our stock is a bargain. Okay, so we've talked about getting paid. Now let's move on to a category of corporate actions that can look really confusing at first glance. I call this the more slices, same pizza section. Why? Because the size of the pizza, the company's total value, doesn't change at all. We're just cutting it differently.
And this right here? This is the answer to our big mystery from the beginning. That moment your shares doubled, but your total investment value stayed the same? You just went through a stock split. The company takes every existing share and just splits it into several new ones. The main reason they do this is to bring the price per share down, making it more affordable and attractive to more investors. Let's just run the numbers real quick so you can see it in action. Let's say you have 100 shares trading at 2,500 rupees each. Your total investment is 2.5 lakh. The company announces a 1-for-5 split. The next day you look at your account and boom, you have 500 shares. But the market price is adjusted down to 500 rupees. And here's the magic part. Look at that bottom row. Your total value is still exactly 2.5 lakh. Same pizza, just 5 times as many slices.
Now here's where things can get a little tricky. There's something that looks a lot like a stock split, but it's totally different under the hood. It's called a bonus issue. This is also where the company gives you free shares. But it's not just a simple division. It's a sophisticated accounting move where the company takes its accumulated profits, its savings basically, and turns them into brand new shares for you.
So let's put them side by side. What's the real difference? With a stock split, you're just cutting up the existing pie. With a bonus issue, the company is actually taking ingredients from its pantry, its profits, and baking a slightly bigger pie. While the end result for your share count looks similar, a bonus issue is a much stronger signal. It says the company is so confident in its financial health that it can turn its savings into permanent capital.
All right, for our final section, we're talking about the big ones, the blockbusters. These are the corporate actions that make headlines. the ones that can completely change the shape of a company and sometimes even an entire industry.
You've definitely heard of these, mergers and acquisitions, or M&A for short. This is when two companies decide they're better off together and combine into one giant entity. So what happens to you, the shareholder? Well, usually one of two things. You might get a cash payout for your shares, or you'll do what's called a share swap, where your old shares get traded in for new shares in the bigger combined company.
And then you have the exact opposite of a merger, a demerger, or a spin-off. This happens when a huge company decides to split off one of its divisions into a brand new, independent company. The thinking is that these two separate, more focused businesses might actually be worth more apart than they were together. And here's the cool part for you as an investor. You usually keep your shares in the original company, and you get brand new shares in the spin-off. Just like that, you own two companies instead of one.
Okay, I know that was a ton of information to throw at you. From dividends to demergers, there's a lot to keep track of. So, to pull it all together and make it super practical, we've made a simple cheat sheet. This is your go-to guide for what each action actually means for your wallet.
Let's just quickly walk through this. Look at the top, a dividend. Your share count stays the same, you get cash, and the stock price drops a bit to reflect the money that just left the company. Now compare that to a stock split. Your shares go way up, the price drops proportionally, but your cash is totally untouched. And then you've got something like a demerger, where suddenly you just get shares in a whole new company. This little table is your quick guide to figuring out the direct impact of any corporate action you see.
So, at the end of the day, corporate actions are so much more than just financial jargon. They are the story of a company's life, its strategy, its confidence, and its failures. The next time you see a headline about a stock split or a merger, don't just skim past it. Now you can read between the lines. The real question is, what story is that company telling you?